Good afternoon, everyone, and welcome to today's webinar. We're glad you've joined us. We had some scrolling slides going a moment ago that reminded you about the CEs available, and every so often we get folks who tell us they're having trouble with their audio, so we've come up with some solutions, and the phone number for GoToWebinar in case you've had any problems. If you have any questions as we go through today's webinar, you can type them in your chat question log on screen, and Mark will address those as he goes along or at the end of the presentation when we'll also open up the phone lines to take verbal questions. So today's presentation is going to focus on term or perm and all the different options that are available to your clients for the different types of insurance. And Mark Maurer is our presenter today. Mark is living proof that sometimes tradition is a good thing. As the son of insurance experts Judith and Keith Maurer, Mark joined Low Load Insurance Services in 2003 and assumed his current role as president in 2008. He earned his CFP designation in 2006 to complement his bachelor's degree in business and finance and his MBA. Earlier in his career, he had managed market operations for an energy trading company and financial operations for an international shipping company. Mark is a member of the National Association of Insurance and Financial Advisors and a popular speaker for financial organizations, including the Alliance of Cambridge Advisors, NAPFA, Garrett Planning Network, LIMRA, LOMA, and Society of Actuaries. He is also a contributing insurance resource to industry publications like Business Week, Bloomberg.com, Forbes, NAPFA Advisor, AMA Physician's Guide to Financial Planning, and Jane Bryant Quinn's book, Making the Most of Your Money Now. With that, I will turn it over to Mark for our presentation today.
Hi, everybody. This is Mark. Thank you for tuning in again today. And as Dina said, we are going to talk about term life insurance or permanent life insurance. And our title is It's Like Choosing Wallpaper. There are many options and many situations. But first, I have a pop quiz. And the question is, who is Cy Sperling? And if you know who he is, you just saw the picture. Please raise your hands if you know who Cy Sperling is. I can't see you, but I hope you all are raising your hands. Cy Sperling, he's famous for his line, I'm not only the president of the hair club for men, I'm also a client. And believe it or not, I'm not only the president of Low Load Insurance Services, I'm also a client. Yes, you heard me right. Believe it or not, I have life insurance. But, and you know, I look a little more like Cy Sperling on the right-hand side than on the left, so at least that's a little good for me. But what we're going to talk about today is the two different types, term life insurance and permanent life insurance. First, what term life insurance can and can't do. I think probably everybody's pretty familiar with what term can do, but see maybe where it doesn't always fit. What permanent life insurance does. How to change from term to perm, and sometimes vice versa. To me, why I own both types of life insurance. And something that comes up occasionally, but I thought was worth talking about is insuring children, and we're going to talk about that. Term is great. Term does a lot of things very well. It has a low premium. It allows you to specify a number of years to guarantee a premium called the term. For any premium dollar, it's going to maximize the death benefit. All great things that we want it to do. Usually it's for income replacement. Your clients starting out, they need a lot of life insurance for as little premium as possible because they have lots of competing goals. And as someone with a 2- and 4-year-old, there are a lot of competing goals out there. But something happened to me, there's a big need. So term fits that very well. But what happens if the term doesn't quite get me as far as I need to go? Well, there are conversion options that provide insurance on your insurability on a term policy. I'm going to touch on that here in just a little bit. When to use term? Term has a specified number of years, a specified end. So we want to match when there's a need that ends. Retirement. Hopefully we all retire, or at least get to a point where we don't need to work but want to. So there's a retirement age when the need for life insurance for income replacement should stop. A mortgage or a loan. Mortgages have a 30-year lock. There's a 30-year need. College. Hopefully children will go to school for not more than 8 or 9 years, and so the need for college, protecting against needing to fund college should in theory end, or at least at some point you just cut the kids off. Minor children, like I said, minor 2 and 4. There are a lot of expenses that would need to be covered if something were to happen to me or my wife to take care of them. So at some point they won't be minors anymore, and so there's a need that ends. Buy, sell, or business insurance. And I say sometimes because sometimes this can be a permanent need, but a number of times when it's a buyout or something with a specified number of years, a very short period of time, term may be the best use of premium dollars for this situation. But all of these events don't normally happen to end at the same time. Hopefully college funding and retirement and kids getting out of the house, if they happen to be all the same, well, that's great, because then that means somebody retired early. But normally it doesn't. And so one thing we like to look at is considering laddering or layering term policies that coincide with some of these needs or life events. So we take our male client. He's age 35. He has kids who are currently minors, but in 15 years they will be, and I use the age of majority, or 18 years old. They can vote, they can do lots of different things. Everyone here usually laughs at me when I say when kids are 18 then they're self-sufficient, but go with me on this. At least in 15 years they'll be out of the house, and then everybody laughs at me again when I say they'll be out of the house. But go with me on that. There's a big need here while the kids are smaller. Then another 10 years after that, while the kids are starting college, the youngest one is, the oldest one is starting college through when the youngest one is finishing college. Another 10-year period of time for $500,000 of college funding needs. And then, usually we take care of ourselves last. So everything else is the last 5 years that our client plans to work is the retirement shortfall. Everything else was getting the kids out of the house, covered, fed. Then we sort of take care of ourselves the last 5 years. And there's where, if something were to happen to the client in the last 5 years, there's an income replacement there to cover retirement shortfall and all those other things. And what you'll notice along the reason that we can look at this, and this is a theory I have, is that every year our client lives, he's satisfying a year of those goals. So every year he lives, he is funding retirement, he is funding college, the kids are 1 year closer to getting out of the house. So in 15 years, he's taking care of all the kids' expenses while they're small. So that need for life insurance in particular to protect the kids while they're small has gone away, and so that's how we can look at this laddering approach. So when I say that the needs don't always end at the same time, if we just look at the longest period of time, 30 years, he's 35, he's going to retire when he's 65. We could say that he needs a $2 million 30-year term. And that might be the right number. Nothing wrong with that. That's a good way to approach it. And assuming a preferred rate, non-smoker, his annual premium is $1,880 per year. Option 2, though, is to look at our ladder. And we have a cool little picture of a ladder there and wallpaper. Nice way to tie everything in. And so we have 3 policies, 3 laddered policies. Just happen to coincide with those life events that I talked about. Now, had we used the term laddering approach, we still have the $2 million for the first 15 years. In 15 years, that $1 million term policy drops off, and there's a total of $1 million of coverage for the next 10 years, and then $500,000 for the last 5 years, getting to the end of 30 years. So For the first 15 years, he still has $2 million of coverage, whether you go with the level premium or a tiered approach. Well, the tiered approach is $1,430 a year, because really what's the most expensive is that last year of any life insurance policy. To cover a 35-year-old, the chances of him dying in the next 15 years are much smaller than him dying 30 years from now when he's already 65. Still not amazingly high, but much more higher chance that a 35-year-old will die at 65 than when he's only 50. So there you have that. So when we compare the $2 million 30-year term at 1880, the initial savings just in the first year are 24% compared to the full 30-year term, and we still have $2 million of total coverage to start with. Now, work with me here on these slides. I was trying to find a good way to get all these together, but in the first 15 years, he saves $450 from using the laddered approach compared to the full $2 million of 30-year term. So 1880 minus 1430 is $450. So he saves $450 for the first 15 years. For the next 10 years, the cost for the 15-year term policy drops off, and so we have annual savings of $880 for 10 years over the 1880. And the last 5 years, because we have the initial savings plus no more 15-year term plus no more 25-year term, we're saving $1,360 over the last 5 years. So over that period of time, over a full 30 years, saving $22,000 over that period of time. Now, he does have less coverage in 30 years and in 15 years and 25-year terms. So it's not a complete way to, I'm not saying that these are equal and he's saving money. There is a trade-off there, but it's a premium savings if we can say that those term layering options coincide with some of those needs. Somebody asked a question, what's the best way to structure terms for a 30-year-old? Should they do a 10-year term policy and get new insurance at age 40 for the next 30 years? Should they take a 30-year term policy now, take a chance on rates when they hit age 60? The question is, what is somebody's insurance? And the reason that you take a longer period of term is because your health is good today. So the ability to lock in my male, who's preferred, lock in those rates for 30 years makes a lot of difference. In 10 years, you can assume that somebody will still be healthy in 10 years and continue to keep getting new policies, but people have heart attacks, people get cancer, people have lots of things happen. And so the reason that you would go ahead and lock in all these premiums today is because they are healthy today. Very few people, pretty much unless you quit smoking, very few people's health actually gets better as we get older. Usually it declines. So there's an option to just lock in the 10-year term policy. And we're going to touch on a little bit what happens at the end of that 10 years, but you would have options to either buy new term, which may be available, but maybe not. You would have the option to convert the term policy, but then you're converting to a permanent policy with much higher premiums. The term policy could go into ART. So the point is that you're locking in that person's age 35, and you're locking in their preferred or even preferred plus health today. And so that's the value to that. Now, I want to say don't get too crazy. The same 35-year-old, but he only needs $1 million of insurance, and because you all like your spreadsheets and financial planning software as much as I do, we can break it down into 5 different time frames and 5 different goals. I don't know exactly what they are, but some of them, they still are retirement, they still are college planning. There's maybe 10 years is the first kid gets to be 18, the 15 years the second one's age 18. So we could do, this is now $1 million policy, or total